Hello friends, how are you? I hope all of you are doing really good. So welcome to Excellency Batch, welcome to KSJ Teaching. I'm your friend Saurav Jindal, welcoming you all to the last chapter of this Excellency Batch. So we have been discussing about international trade and international trade. This is the last topic. Overall, for the economics or finance, this is the last chapter that we are going to start with, and we'll be completing in 2 to 3 lectures maximum, right? This is a very easy chapter, very easy chapter, sir. The common sense chapter, right? International capital movements. Now, what is capital here? This is money. Basically, how the money flow from one country to another country. How it can be invested in one country, how it can be invested in other country. What will be the benefit of investing, right? How the money can flow from one country to another country. This is what is meant by international capital movements. And in this chapter, broadly, there are two major topics. One is the FDI and one is the FPI. Right now, all of you must have heard about it. We will read it. What is FDI? What is FPI? What are the benefits of FDI? What are the disadvantages of FDI and FPI? Right. So let's see. Foreign capital. The foreign capital includes any inflow of capital into the home country from abroad, right? So if in India the US dollar is coming, that is known as the flow of capital, right? Now, types of foreign capital, that how the money can flow in the form of grants. That is, the foreign grants are voluntary transfer of resources by the government, institutions, agencies and organizations to a home country. For example, there is some problematic situation in one country. Let's say in India, there is some problematic situation. So USA wants to help India, right? So what USA will do is USA will send the grants. That is the voluntary transfer, voluntary contribution done by USA towards India, right? So what is that? The foreign capital inflow into the home country, right? So the foreign grants may be direct inter-government grants, that is by one country to another, right? So US government giving the grant to the Indian government giving the grant to the Nepal government. So it can be anyway like this, right? Directly between the governments there is exchange of money, and that is on the voluntary basis. Then is the indirect grants, the pooling of grants by two or more governments through IMF, that is the International Monetary Fund or the World Bank, etc. Right, two or more countries, they come together, they pool the funds and they give it to the World Bank or the IMF, and then that money reaches another country. Right, like two or more countries of the Europe, they come together, they pool their grants, they put that we will contribute this much, we will contribute this much, and they deposit it with the IMF or the World Bank, and through that the money is transferred to the another country. Let's say that is transferred to India or Nepal or wherever, right? Then is another is in the form of aid. Another is in the form of aid. The foreign aids may be classified into. Now, the grants are not for a specific purpose, we can say. That is not a aid. The grant is the voluntary contribution between the countries. Aid is, one is the tied aid, that is with the strict mandate regarding the end use. Help. Basically, we are providing this money also for help. Aid is what? Aid is for help, right? But we, in this case, in the case of tied aid, we mandate, we strict instructions are given that the money should be used only for the specific purpose for which it has been provided, right? For example, an American person comes to India and he provides the aid in the form of educational, for the educational purpose, and he specifies that the money what he is providing is to be used only and only for the educational purposes. That is what is aid, for the specified purpose. The untied aid, mere aid assistance without any stipulations are to end use. Like he gives the aid for this for the education purpose, and he say, okay, you can use it for in the within the education purpose, you can use it for anything, right? So that is the untied aid. You are not tied to a specific cause that you have to use it for this purpose only, right? After that, the borrowings can be there. One government can borrow from the another government, one country can borrow from another country. Direct intergovernment loans, that is directly the government is buying some money from the international. Loans from the international institutions like the World Bank, IMF, that is also the inflow of the foreign capital. The soft loans from the affiliates of the World Bank, that there are the other institutions which are the affiliates of the World Bank, right? Another banking systems which are affiliates of the World Bank, we take the loan from there. External commercial borrowings. Commercial borrowing means the business borrowings. One business borrowings. A business in India borrows the money from the business in USA, right? Or a business in India borrows the money from the bank in USA. That is external commercial borrowings. Then is the trade credit facilities. Now during the trade, if you are providing the credit facilities, that is also in the form of borrowings. Foreign investment, FDI in industrial, commercial and similar enterprises, and the portfolio investment in the bond stocks and the securities. Now FDI and FPI, this is what we have to study in totality. Now in this whole chapter we'll be talking about FDI and FPI, and this is the most important part here, right? This is the most important part here. Now just try to understand what is FDI and FPI. Let's try to understand, sir. Now there are two terms. One is FDI. He's talking about two terms. One is the FDI and another term is FPI. Right? Now what is happening here? There is a person, let's say Mr. X. Mr. X, he is a USA person. Right? Mr. X is from USA. Right? Now he wants to invest in India. So he has two options. Either he invest in some company, he invest in shares, or we can say the ownership of a company, right? Another way of investing is he invest in the bonds, he invest in the capital market, he invest in the capital market in India. Right? Capital market can be is investing in bonds, debentures, one and the same thing, right? So these are the two ways. Now, when he is investing in the asset of a company, the share is what? The share is an asset in which he will be getting the ownership rights. He will be getting the ownership rights. This is known as FDI. And when he is investing in the capital market, that means he is investing in the bonds, debentures, this is known as FPI. Right? This is known as FPI. Clear? So FDI is when you are investing in the ownership rights. Now, if you talk about FDI, let's talk a little bit about the FDI now. Now, in case of FDI, we say you will get the ownership rights, right? Ownership rights. How you can invest in the shares? You can invest in shares of a company. You can buy the shares of a company. Like Mr. X, he is from the USA, he comes to India, he buys the share of a company in India, right? Acquires the share. Or what can be the another way? The another way of setting up the FDI is setting up the ancillary units. Ancillary or the subsidiary units. Now a company in the USA, what they are doing is they want to invest in India, but how they will invest in India? They set up their own subsidiary unit in India. That is what? That is investment only, sir. They have the ownership there. They have the ownership. The US company has the ownership. They are investing in India, right? So they set up their ancillary units in India. But in case of FDI, there is a rule that when it will be considered a foreign direct investment, if these ownership rights, if he is investing in more than 10%, right? Whereas there is no such rule in case of FPI. In case of FDI, you have to invest more than 10%. Your ownership should be more than 10%. Only then it is considered as the foreign direct investment, that a foreign person or a foreign company or a foreign government is investing in another country. Now, one important thing that you need to understand, that now Mr. A is going to invest in India. Mr. A has two countries now. One is USA and another country is India, in which he is investing, right? So what is USA called? Sir, this USA is known as home country, right? This is known as home country, and India is known as host country for Mr. A. right? So India is being considered as a host country and the USA being the home country, right? So these are the small things that you need to remember. I've given you just the overview that what is FDI and what is FPI. Let's see. Now, the foreign direct investment. According to the IMD, the FDI refers to all the investments involving a long-term relationship and reflecting a lasting interest and control, right? You will get the, when you are getting the ownership, you are getting the control of the business, sir. Okay? Of a resident country in one economy. Mr. X, a resident of USA, of a resident entity, entity can be an individual also, entity can be a government also, entity can be any business setup also, right? Of a resident entity in one economy, in an enterprise resident in an economy other than that of the direct investor. So if he is investing in USA only, then that is not an FDI. He has to invest in some other economy. So FDI is also defined as a process whereby the resident of one country, that is the home country. So for Mr. X, USA is the home country, acquires the ownership of an asset in another country, that is the host country. Now he is acquiring the ownership of the asset. That is what? Sir, the ownership of the company is owning the shares. That is an asset, right? And such movement of capital, if he wants to buy the shares of a company, obviously he will pay money. He will invest in that. That is what? The movement of capital. He will pay the US dollars. He will give the US dollars and get the shares, get the ownership right, get the control. Involves the ownership, control, as well as the management of the asset in the host country, right? It encompasses the initial as well as subsequent transactions between the direct investor and the concerned enterprises. Today also he is buying 10% shares. After let's say 1 year, he buys another 10% shares. That will be included in the FDI, the initial transaction as well as the subsequent transactions, right? So what are the features? The investors are there. The foreign direct investors may be individuals, incorporated or unincorporated private public enterprises. Governments can be there, government agencies can be there, estate, trust, any kind of institution can be there, right? Investment criteria. As per IMF and the OECD, the acquisition of at least 10% of the ordinary shares or the voting rights in a public-private enterprise by the non-resident investor can be termed as FDI, and India follows the same classification pattern, that if you want your investment to be classified as the foreign direct investment, then it should be minimum 10% acquisition of the voting rights. Components. FDI has three components, with the equity capital. Obviously, you are buying the equity. Then the reinvested earnings, that you earned something and you reinvested in India itself, right? And other direct capital such as intra-company loans between the parent and their affiliates. Now, let's say the parent company is in USA, the subsidiary company is in India, right? And this parent company gives a loan to the subsidiary company in India. What is that? That is again the flow of capital, right? Real investment. Direct investments are the real investment in the factories, assets that you can identify, sir, that this is the investment in the asset. It is not a nominal investment because the asset is there in reality, right? Land, inventories, and involve the foreign ownership, control, and management of the production facilities. Obviously, if you get the ownership of a business, you can alter the production facilities. You have a say in the productive capacities, facilities, and all those things, right? Okay. Now, what is the types of FDI? There are various types of FDI. One is the horizontal FDI. What is horizontal FDI? That investor starts the same type of business activity in a foreign country as it conducts in the home country. For example, the Walmart purchasing the Flipkart. Now, the same business is being done in the USA. The similar business, the similar activity, Mr. X acquires in the India, right? So that is known as horizontal FDI, when you are moving on a straight line. Now, what is vertical FDI? Vertical FDI is investor establishes or acquires the business operation in the host country, which is different from the investor's main business activity, but it supplements its main business activity, right? Now, what is there? Now, Mr. X in USA. Now, Mr. X in USA is having a shoe factory, right? He is having a shoe factory. He sells shoes. He makes shoes and he sells shoes. Now, in India, he buys a business which is not related to shoes, but that will aid in the making of shoes. For example, the Suzuki investing in the auto parts manufacturing company in India, right? So Suzuki is what? They are not manufacturers of auto parts. They are the manufacturers of the cars and all those, right? But they invested in the auto parts in India so that that can aid, that can help their business grow, right? Because the auto parts manufacturing is required for the cars, right? Like Mr. X invested in India in what? In the shoe sole making factory, right? There is a sole making factory. So this Mr. X in USA, his main core business is not the sole making, right? That is shoe making, but he invested in India in a sole making factory, not a shoe making factory. Only he was making the soles for the shoes so that this business can aid his main business in the home country. That is known as vertical FDI. Then is the conglomerate FDI, that is the investor makes investment in a business operation that is unrelated to its existing business in the home country, absolutely unrelated. For example, the Uber invest in the Zomato, it would be conglomerate FDI. That means they are coming together for a new thing. Simple. They are coming together for a new thing that is not related to the existing business at all. Clear? Two-way FDI. Two-way FDI is the reciprocal investments between the countries that occur when some industries are more advanced in one nation while other industries are more efficient in the other nation. For example, uh, in USA you will get the capital intensive industries. In India you will get the labor intensive industries, right? So they can cross exchange. They can cross exchange. If the USA wants to invest in the labor intensive market, they can invest in India, and India wants to invest in the capital intensive markets to get the technological advancement and all those things. India can invest in USA. Clear? That is a two-way FDI. That means two countries investing in each other. It is not a one-way traffic. So this is important from the examination point of view. The types of FDI, it has been asked in the past also, and it can be asked in the future also. So modes of FDI is how the FDI can be operated, sir. Opening the subsidiary or the associate company in the host country, as I told you, right? Injecting the equity into a foreign company, that Mr. X buys the equity share, they injects the money. Acquiring the controlling interest in the existing foreign company, mergers and acquisitions can be there, joint ventures can be there. Greenfield investment, that is establishment of the overseas affiliate for newly starting production, right? There is a company in the USA who wants to start a production in India, right? So they establish their office in India. That is what is known as greenfield investment, establishment of overseas affiliate for newly starting production. They want to start a new line of production, and they see that India is a potential market, India has a good market, so they want to set up the office in India. They will set up the office in India, and obviously if you want to set up the office in India, that means you are investing in India, right? That is what is known as greenfield investment. Clear? After that, so this was all about the FDI. After that comes the foreign portfolio investment. Now what is FPI? FPI says there is no direct controlling over a company. You are investing in the bonds, you are investing in the capital market. This is how the money is flowing. So FPI is the flow of financial capital between the countries. For example, the bank deposits in a foreign country, purchase of foreign country bonds. Now if your money is deposited, let's say Mr. X, this Mr. X has let's say rupees 50 lakh deposited in, let's say, SBI, right? In India, the State Bank of India, he has 50 lakh rupees deposited in the SBI. Now this is what? Is he getting the control over the SBI? Is he getting the voting rights in the SBI? Is he getting the ownership in the SBI? No, sir. But still, the capital is flowing from Mr. X to India in the form of this deposit. Similarly, if Mr. X is buying the bonds and all those things, in that case, he's not getting the ownership rights. He's not getting the ownership rights, but still the money is flowing from Mr. X from USA to India. Clear? So it does not involve the ownership or the control on the part of investor. Unlike the FDI, this investment is usually short term. This can be short term. Now Mr. X can withdraw anytime. Now when you are investing in a business, In case of FDI, we say you invest in the full-fledged business, you are getting the ownership rights, you have the responsibility now. If you are setting up your business subsidiary in India, you have the responsibility of carrying it for a long period of time. Is it possible that you set up a business today in India because you want to invest in India and tomorrow you close it? No, 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 I don't feel like doing it. Let's close it. Can you do that? No, sir, you can't do that. Right? But in case of FBI, if 50 lakh is deposited in the SBI, you can withdraw it anytime and take it back to your country. If anybody can stop you, nobody can stop you, sir. So it is normally short term in nature. FDI is normally long term interest in the business, right? So what are the features? The investment in the capital. FPI includes investment in the financial stocks, bonds, and other financial instruments in host country and is made through capital market. That is what I told you, right? So intention of investor is to earn the remuneration. Now, what is the intention here? That whatever the investment I have made, I should be getting a very good return on that, right? But that is personal return only. To earn the remuneration by investing in a foreign security, the investors are mainly concerned with the safety of their capital and the possibility of its appreciation, that whatever the money they have invested, that should be safe. The capital loss should not be there. Plus, if you get additional return, that is the additional benefit. Effect. The immediate effect of FBI is usually on the balance of payment and the exchange rate, because if there is sale and purchase of the bonds, then it can affect your balance of payment and the exchange rate. For example, the 50 lakhs rupees, let's say this is in terms of dollar, right? He has deposited, let's say $5,000 in SBI. Now, if he withdraws this $5,000 from the Indian economy, that will affect the balance of payments or not? That will, sir, right? Investment criteria, the FPIs are characterized by the lower stake in the companies. Now, in case of FDI, I told you that it has to be at least 10%. In FPI, in case of FPI, it can be less than 10%. There is no such criteria, right? Within their total stake at below the 10% can be there, right? Risk, the FPIs tend to be speculative. There is higher risk in the FPIs, right? Because they are dependent upon the market demand and supply. When the investors lose the confidence in the prospects of the company, they usually shift their capital to another company or the country. Now, if the investor sees that we might not be getting the good return in India on the bonds, or in the SBI, we might not be getting the good interest rates, they will withdraw the money and they will invest somewhere else. As simple as that, right? So this is the FDI and the FPI that we have explained. Now, this is the difference that is given. Just read it once, right? Just read it once. Simple. The whatever the differences are, we have already discussed. If you have understood the details, just read the differences. But yes, the difference is important from examination point of view. This is important. Just read it. You will be easily able to understand each and everything, sir. Right? Now, let's coming to the next topic, that is the reasons for FDI, reasons in favor of FDI, why the FDI should be there, right? So this is the reasons for FDI. General reasons: higher degree of interdependence on the national economies and the higher level of trade relation. If you want to maintain the good trade relations with the other countries, right, then FDI is a good option of maintaining the good relations, interdependence. Emergence of the multinational companies with the subsidiary and affiliates, leading to internationalization of the production and the investment. Now, if a product is being produced in the USA, it is not necessary that it will be restricted to the USA only. Right now, through FDI, they can set up the company who is making the product in USA. They can set up their office in India and manufacture the product in India. That is what? That is FDI. The need for making the defensive investments abroad in order to preserve a firm's competitive position. For example, acquiring a growing foreign firm to avoid the future competition. For example, there is a Mr. X. Mr. X is having in USA a shoe company, right? A shoe company, right? And the brand, they are making some specialized, we can say sport shoes. Specialized. Now they see that in India also there is Mr. Y who has started the same category of shoes. Same category of a particular shoes. Mr. Y is starting a company in India and is growing fast. So what this Mr. X will do? Mr. X will come to India. He will try to acquire this so that his competition, earlier he was the sole manufacturer who was sending it to USA, who was sending it to India also. Now what he will say, he says, okay, give me your ownership rights. He will try to acquire Mr. Y by giving a good amount of money, right, so that he doesn't have to face the competition. So that is what is there, defensive investment, that you want to defend your business from the competitiveness in the international market. Promoting the best use of the physical, human, financial and other resources spread across the world. Obviously when you invest in some other country, you are getting the best of technological resources, financial resources, human resources. Let's say a US company invest in India, they open office in India, right? And in India, we know that people are very hard working. So they are getting the best of human resources in India. They're getting some of the finest brains of India, right? The physical capital they're getting, the other resources can be there. India is rich in the natural resources, they are getting for that. So this is how the FDI can help in the technological exchange, in the human exchange, in the financial exchange, and a lot of other things, right? Shared common language or common boundaries and possible savings in time and transport cost because of the geographical proximity. Now, why you want to invest in India? Because whatever the product you are making, you see the raw material is easily available in India. So you invest in India, you open an office in India so that you do not have to take the raw material from India to USA. That will include the tariffs also, the custom duties also, and so many taxes that will make it very costly. You say, let's open an office in India itself, right? The philanthropic objectives like strengthening of the socio-economic infrastructure, elevation of poverty, maintenance of ecological balance of the host country. So if you want to maintain some good relations and you want to contribute to the development of the host country, in that case, the FDI is helpful, right? So these were some of the general reasons. Then is need to maximize the return on investment, desire to secure access to the raw material located in other countries and earn the profits through processing them to the finished goods. That is what I told you, the easy access to the raw material in the host country. Strategy to obtain the control of strategic raw material or the resources so as to ensure that the uninterrupted supply at the lowest possible prices. You want to control that particular area, right? Let's say a person comes and establishes a factory in the Gujarat, right? Why? Because he says it is a strategic location. It is easy to get the raw material. It is easy to buy the raw material and other resources can be easily get through at the lowest possible prices. Desire to reap the economies of large-scale operation arising from the technological growth. You can increase your production with the help of the technological exchange. Necessity to retain the complete control over the IPRs, intellectual property rights can be there, that nobody else should be able to do what I am doing, right? Necessity to retain the direct control of production knowledge and the managerial skills. If you are having a factory in USA, you say I have this product is really requires the specialized skills, specialized knowledge, and you want that product to be sold in India, but you don't want to share that knowledge with anyone in India. You say, I will set up my factory, I will invest in India and I will start the production instead of sharing the knowledge with someone else. Clear? The ease of penetration into the market of the countries that have established the import restriction. Now, if a country is having the import restriction, this is a very good alternative way. Invest in India, invest in that country, right? If you don't want to pay the tariffs, if you don't want to pay, if you don't want that the country should be charging the huge tariffs, then what is the alternative? Sir, invest in that country. That is the best thing to get the entry to sell your products. Make the products in the country, sell the products in the country, enjoy by establishing a production facility within that country, right? Now, what are the factors in the home country? What are the factors for FDI in the home country? High GDP and per capita income leading to abundance of capital. Now, in the home country, the USA is having the high GDP and high per capita income. There is abundance of capital. They say, where do we keep this capital? Let's invest in some country, right? Shortage of labor and hence the high cost of labor in the home country. Now, the USA is majorly a capital intensive country. There, the shortage of the labor is there. Now, if the labor will be in shortage, they will ask for more money, isn't it? So that will increase the cost of the product. They say, let's invest in some country which is labor intensive. They can invest in India, which is abundance in the labor, right? Particularly when the production process is labor intensive. Risk diversification so as to ensure that the recession or the downturns have the lower severity. What is risk diversification? They say in case there is a recession in the USA, in case in future there is a recession in USA, Mr. X will think it's okay. It's okay. I have a business in India also. That will save us to some extent. That is known as risk diversification. You are diversifying your risk so that if this fails, this is there. Right? If one thing fails, the second thing is there. So you are diversifying your risk. The image building through investment generating activities and the investment facilitation services, right? That you are, if you are investing in India, obviously your image will be good that, oh, Mr. X invested in India, right? He is doing a good job. He is a good person. Then what are the factors in the host country for the FDI? What are the various factors which contribute in the host country? The lower level of economic efficiency in the host country. FDI will definitely help in improving the economic efficiency. The economic efficiency means you have the resources, but you are not able to potentially use that resources in the right way. Large and rapidly growing high potential emerging markets with the growing population. There is a huge market for the product. The population is growing, and as such, the demand of the product is growing, right? So FDI, a person comes from USA, set up the business in India of the chocolates, right? If you have the emerging markets, then that will sell. Good level of social amenities in the host country, right? A stable political environment and a favorable investment climate in the host country. That is very important for FDI. Abundance of labor and hence the low cost of the labor. Again, these are the factors which help the foreign direct investors to make their decision. If whether it is there is a political stability or not, whether the proper social amenities are there or not, good food, good shelter, good water is there or not, right? Investment climate is favorable or not, labor is there or not. If it is a labor intensive factory or the business, then they will look for whether the labor is available or not, right? Now, the reasons discouraging FDI, why they say the FDI is not good. Political instability. If there is political instability, then the FDI should not be there. It is not why FDI is not good. It is why what discourages the foreign investors to invest in the country. Political instability, lack of security to life and property, poor infrastructure, small size of the market with a lack of growth potential. If the market is not there, let's say Mr. X wants to invest in India, but he sees that there is no market for the product in India, then why will he invest in India? That will be the wastage of money, isn't it? Poor track record of investment, the investment climate is not there, the scenarios are not there, the lack of openness or the friendliness for the foreign investment. If the country doesn't show the friendliness, if there are strict rules and all those things, then the investment will not flow. The macroeconomic factor, high rates of inflation, the balance of payment deficit, exchange rate volatility, and the low level of income and the lower demand, right? If there is inflation in the country, why would someone invest, sir? Why would someone invest, right? The demand will be less. So exchange rate volatility is there. If the Indian rupee is quite volatile to the, let's say, US dollar, it keeps on increasing, it keeps on decreasing, then why would a person invest? If the balance of payment is already in the huge deficits, right? Again, then why will he invest? Labor related poor literacy and low labor skills. If there is a business who requires the skilled labor, but there are no skills, right? If there is abundance of labor, but there are no skills, or there is no learning capability of the people, then why would that person be investing? Rigidity in the labor market, dominance of labor union, and high rates of industrial disputes. The law or governance related, the bureaucracy and corruption, higher degree of non-tariff barriers, unfavorable tax regime, law not favorable to the IPR protection, cumbersome legal formalities and delays. So all these reasons are which discourages a person or an institute who wants to invest. This discourages. Please do not invest for these reasons, right? So this is what is the reasons discouraging the FDI, that which discourages the investor for the foreign direct investment, right? So we are already done with almost half the chapter. The next is very simple, the benefits of FDI for the host country, right, in which the investment will flow. Then what will be the problems or cost of FDI for the host country we can study. Then will be benefit versus cost comparison, measures to control FDI, then FDI in India, how the evolution took place, then government measures to promote FDI, then rules for investing in India, then overseas direct investment. That will be the last topic, right? So most likely in the next lecture we are going to complete this particular chapter, as well as we are going to complete the syllabus also. I hope all of you have enjoyed it, And if you have enjoyed it, please do share with all your friends. This is a small contribution that you can make. And for the handbooks, you can go to our website, that is www.ksjteaching.org. See you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.